Good morning, everyone. Anthony Iser here with another ITPM Flash. And today I'm going to talk about why you shouldn't flog a dead horse. The dead horse I want to talk to today is about shorting the US residential construction sector. Now, this was a really good trade in 2021, December, when the Fed came out and said we're going to start raising rates because the market's forward looking. We know that that's going to have an impact on the sector. And sure enough, the index was down about 50%, near enough to it, as you can see from this chart here. But since then, it's almost doubled. So rather than sit there and say, let's keep shorting this into this strength, let's work out what's gone on and why. Firstly, why do we think it should have gone down in the first place, and why did it? There's three reasons for that. First thing, when rates go up massively, borrowing costs increase. As you can see from this chart here, mortgages more than doubled in cost from $1,500 to $3,000 over this period. This has the impact of lowering demand for housing stock. As prices go, as that mortgage cost goes up, prices also come down. People simply can't afford the same sort of house that they were anticipating buying in the first place. You can see here, medium sale prices coming down and being negative. So house price declines. These are all expected things, and that's why the sector moved down dramatically in the first half of last year. And the impact at the stock level, prices down, volumes down, means revenue down, costs are hard to adjust, should see earnings down dramatically for construction companies. That's what was anticipated. Now, this sort of happened, but not to the degree that was needed to see the follow-through coming through. And hence, these construction names have nearly doubled since then. So we don't want to sit there and say, this should have happened, it must happen, and keep flogging this dead horse trying to short this sector. We want to understand why this has happened, just to determine if there's a possibility of this trade happening at some stage in the future or not at all. But at this point in time, there's enough there to say we want to stop flogging this dead horse and stop trying to short this sector. Now, there will probably be a time that there's a couple of things that would need to change. So what has driven this strength in this sector, which was unexpected? Simple thing is good old supply and demand. So existing homes make up a very large percentage of homes that get sold each year. The new homes that construction companies build is a very small percentage. And what's happened is the supply for sale of existing homes has dropped dramatically. So the supply of the whole market has dropped. And what we've got at the moment is inventories sitting there at about a 3-month level, which is as low as it's been in a couple of decades, back to 1999. Now, this is a function of homeowners being locked into very low rates that happened in that post-COVID period. In some cases, people are locked into mortgage rates of under 3%. So they'd be crazy to put their home on the market, sell it and move and get a new mortgage at near 7%. So that's taken this huge volume out of the market. Massive reduction in supply. As you can see from this chart here, things have fallen off a cliff. Even as recently as GFC, numbers were more than 1 million higher than we're currently looking at. Second thing that's happened is construction companies have been offering cheap finance, often 1% under the sort of rate that you would get at a bank if you buy from one of their new projects. But this has had the added effect of lifting demand for that smaller segment, that new home construction. Now, this is not a sustainable thing, I don't think, but in the short term, it's certainly going to help things along for these companies. And so as you can see on this final chart here, new home sales, as such, have defied the downturn. We would have expected to see that orange line to continue down along with mortgage applications, but it hasn't happened. And at this point in time, even though it should probably get there at some stage, there's not enough evidence for us to go and fight that. We need to see some substantial changes in the market, some real dislocation in order to see these earnings come down. And ironically, it may be that interest rates have to come back a long way to bring a lot of that existing home stock onto the market. So there you go. We're not going to flog this dead horse. We're going to look for other trades. But at some point, this might work out. But at this stage, we want to hold clear. Thanks very much. See you soon.